This is a stock analysis update for Cornish Metals. To start this presentation, please remember that I do these videos just for fun as a hobby and always speak to a qualified financial advisor before making any investment decision. So I just did a massive 45-minute video on Cornish Metals, so please take a look at that if you haven't seen it. I also spent an hour discussing Cornish Metals with the guys over on the Portfolio Matters Discord channel, so you'd be interested in that as well. Now, I got a lot of feedback during that call, and also over on the London South East forum, I got some good feedback from Valuation It Is, so thanks a lot to him. And also on the Portfolio Matters Discord, I got some feedback from Uncle Tom as well, so thanks a lot for that. So following all this feedback, I've had to do a update video. And straight off the bat, actually, my original market cap was wrong because of the old Canadian dollar FX issue. And actually, the market cap is 93 million Canadian dollars. And so, right off the bat, that now gives us a price to book of about 1. So, actually, considering all the risk, Cornish Metals aren't really at a good price right off the bat here, with a price to book of about 1 at the current share price. So got pointed out that actually the dewatering of the mines isn't going to end until 2025. So we've actually got ages right into the middle of 2025 before we'll be at the point where we can be thinking about the final investment decision. Also, I looked at the technical report. This is the latest technical report, the one that got us these updated resource estimates. And in that, they actually recommend more surface drilling and drilling from the lower mines after they're drained in order to support the feasibility study. So these are more hurdles as well that you've got to think about. And generally, I think that next year we're going to have some teaser RNSs about the wide formation drilling and then the actual results from that and all that. And although that might lead to spikes in the price like we've seen in the distant past, ultimately, as I'll go on to later, the most important factor regarding the final investment decision going ahead is going to be the price of tin. And so that I think is the most important thing to focus on. But the good news is we've got way into 2025 before, in order for us to establish the price of tin and whether or not we think the project will be going ahead. So, of course, the 2017 net present value of 177 million Canadian, this now doesn't look very impressive stacked up against the current market cap. So we had a lot of discussion about the economics of the mine, and so I've spent some time evaluating this. And Uncle Tom pointed me towards this 2017 technical report, and this has been very helpful in teasing out the economics of the mine. And the first thing, and actually the most apparent thing, is in that report with that plan, which they've referred to this 100 million kind of value. So I'm assuming it's a similar plant that they'll be building in the once we get to this feasibility study. But the thing that stands out the most is that they're expecting, even in that 2017 study, to mine 350,000 tons a year of ore from that mine. And then when you extrapolate that to actually how much tin is removed, that would be about 5,400 tons per year. And that's actually more than double the amount of tin that was being removed from that mine back in 1996. So, first of all, we have this question of, is that a bit over ambitious? And then, which works out at being producing double the amount of tin that it was producing back then. So that for me is a bit of a added risk factor that I didn't consider in my previous video. that, are they really going to be able to achieve these numbers? But assuming that they do, I first of all looked at their 2017 assessment, and I've done my own calculations based on that. So I have 43,000 tons being mined over 8 years of actual tin, that is, given this amount per year. And so at the $22,000 per ton price in pounds sterling, that then gives us 93 million per year. So I've gone back to this original slide deck for all the cost numbers. So we've got the pre-production capex and then the capex post-production, which I've split evenly over each year. Then we have those revenues I've calculated at 93 million, which I've done a discounted rate of 5% per year. Then the cost of production, and that's actually the AISC cost, which I got from that original slide, and also this preliminary assessment that I got hold of. So that gives me a cost to produce every year, giving us a profit. And then I've added tax, which back then was 19%, giving us a cumulative profit after tax. And actually my number agrees very closely in Canadian dollars to this original number we're presented with. So I'm quite pleased with my model here. And then from that, I'm able to generate this lovely NPV curve. And so that's my assessment for the original 2017 proposal. But we have to say that when we look at that versus the current market cap in Canadian dollars, you have to kind of wonder, given that this will be a payback over 8 years, would that really be worth it? And also, we've now got to think about inflation and also the updated resources. So now the current estimates have greatly increased from 43,000 tons to 81,000 tons. But the mine life has increased to 15 years. And of course, this original plan, which, could be ambitious because it seems like a very large amount of material being extracted from the mine. This actually does set a limit on how much you can actually process every year. Just from this limit here, if we're sticking to this as our base plan, and obviously the lower the grade of tin, then the less tin you can process each year from that amount that can be recovered from the earth per year. So accounting for that, we get a maximum of 5,400 tons per year, assuming it was going at full go. Actually, in the original plan, there was a ramp up, but for simplicity, I just averaged it all over over the entire length of the mine life. But yeah, given that, we would still get this amount because you could up slightly the amount per year to then be at the maximum. And this would give us a 94 million per year revenues. And the length of time is now 15 years. And that information is only available from one slide that they presented this year, where we now have a mine life of 15 years. So then that got me a 94 million revenue per year at 22,000 tin. And then we see that here. And so it's similar to what we had before. And, perhaps is that enough of a return? We still have to ask. But then what if we think about inflation? So what I did next is I considered, well, what if we add 30% inflation to the capex spend plus 30% to the cost to produce. So as you can see down there, that's the capex, and also the running costs being the AISC cost, or the average life of mine all-in sustainable cash cost, which is quoted per ton. And from that, unfortunately, we find that at a $22,000 tin price, when you then think about adding inflation, all of a sudden the mine appears to be, according to my amateur calculations, not really economically viable. So I then thought about what about at different prices of tin? And we can see after accounting for inflation, the mine isn't viable at $22,000 tin. It's questionable at $25,000 tin. But actually, at $30,000 tin, we then do get a NPV of about 400 million Canadian dollars. So actually, at $30,000 tin, it starts to look quite promising. So a big takeaway from this bit of extra work I've done is, in my opinion, according to my wonky maths, you really are going to need $30,000 tin in order for South Crofty to be viable. Now, I was interested though in, obviously, 350,000 tons of ore seems like a large amount to be removing from the mine and is double what they were removing historically. So I was thinking, well, what if, worst case, they can't remove that? Or what if, we talk about the wide formation being at just 1%. What if there is all this extra resource, but it's only 1%? So again, then that would be actually a similar effect to having a lower amount you're removing at the higher grades. So in those kind of worst case scenarios, how does it all compute then? And what I find was, obviously then you have a longer mine life. However, because of the effect of the discounting rate of 5% per year, then actually it becomes less profitable, after a certain number of years, so that you don't get all your juice out as you would had you mined it, within just 15 years. And so because of that, if we assumed that they were only able to extract 3,000 tons per year, which is actually still more than they did back in 1996, but would represent what would happen if their predictions were a bit ambitious about how much they can remove, which is kind of double what it used to be. And also, perhaps if there's more tin there, but it's lower grade, would kind of model this as well. Um, there we find that actually, even at $30,000 tin, it's still questionable. It's actually only about 60 million NPV after 15 years, after which you'd have to just close the mine because of the discounting rate effects. So actually, this tells us that they really do need to meet these perhaps ambitious targets of removing 5,400 tons a year as well in order for it to be viable. And finally, I'd also been getting a bit of feedback, and I discussed with Portfolio Matters quite a lot about the effects of share dilution, because they're going to have to issue a lot of shares in order to raise that 120 million. And I've got here pie charts showing the share dilution required. And as you can see, at the current share price, it's a ridiculous amount of share dilution. At 30p share price, it's not so bad, but it's still quite significant. So what effect does that have on the prospects? Now, what I've got here is the existing number of shares, price, which is in pence, and the market cap, which I've converted into Canadian dollars, and then the book value, which is in Canadian dollars. And so from that, I've got the price to book. And first of all, even at the current share price, they're already at a price to book of 1. And at the 30p share price, which looks more realistic in terms of share dilution, There you're talking about a price to book of 3 to 1. So that's not very not too favourable. And anyway, I've then got at the different prices the amount of shares they'd have to issue to raise 120 million at those share prices, and then that gives us a new market cap and a new book value. The book value would be the same because it would just be the existing one, plus the 400 million, sorry, plus the 120 million raised, which would go into the assets, as cash initially, and then if we're being nice, would then get, as they built the mine, would get converted into mining assets. So we then get, if the final investment decision and the fundraise went ahead, we then get the new book value and a new price to book. And what we see is that at a 10p price, the actual price to book becomes unfavorable. So actually, you'd expect the share price to go down actually, to equalize at 1. Totally technically speaking, obviously in reality there'd be more excitement and stuff, but in terms of the pure maths, it doesn't really work at a 10p share price. But at a 30p share price, then the price to book actually gets slightly more favorable. And if there was above a 30p share price, the dilution effects would not be negative. But at the 30, we don't end up any better off in terms of price to book at 30p share price. And really, we're at this reality. They're at the 30p share price, and 30p is actually what it went up to. Funnily enough, coinciding with the tin price spiking around then as well. But when the markets clearly thought this was all viable, then the share price did go up to about 30p. So presumably we could expect that if the tin price started going up again, then everyone would be thinking, yep, this looks like it'll go ahead. And we could expect the share price to go up to 30p again. But the problem is then that we have a price to book of 3, which, when you think of all the risks, seems like a high price to book. And then even after the fundraising, which hypothetically I think would happen at about 30p, we're stuck at the same high price to book. And then when we look at what value is going to be added by running the mine, 402 million Canadian, that's only really a not even a 3x, on the amount of money in the business. And also, you've got to consider that that's going to happen over a 15 years time horizon. They'll be creating those revenues. So actually, when I look at the price to book, and when I consider the effects of share dilution, and then consider how much money we can expect to come into this project, actually how much money we can expect them to generate, really the upside isn't really all that great when you consider the risks. So to summarize, according to my wonky maths, I don't think that the South Crofty project is viable unless we have $30,000 tin. The upside over 15 years at $30,000 tin isn't really all that amazing against the current market cap when you consider that this is going to be over a 15-year time period, and then also considering the risks. The good news is we've got absolutely ages well into 2025 before we can expect the mine to be dewatered and to be ready for a final investment decision. So that gives us plenty of time to study the tin price and hope that it starts to look like it's settling above $30,000. Ultimately, having better assessed South Crofty, I think that really the longer term upside for this company is more about actually how valuable are all of these mineral rights that they own throughout Cornwall. That's really where I think the 10x kind of potential could be. The South Crofty on its own doesn't seem really so interesting now I've had a better look at it. But of course, whether they're able to unlock the value of all these mineral resources is totally in the realm of speculation. So they stay on my watch list, but really I'm looking for a tin price of above 30,000 before I even look at them again. So I hope you found this video useful and good luck with your own investments. I do videos like this one just for fun as a hobby. It's for entertainment purposes only. You'd be really stupid to make any kind of investment decision based on this video. Always consult a qualified financial advisor before making any investment decision. Prices can go down as well as up.